What's up, everyone? It's Cato with Money Investing. Welcome on board for another Market Open live stream here. We do have Jerome Powell in about 15 minutes. He speaks at around 9:10 a.m. So I will bring up, this actually event is going to start in about 5 minutes. This is the Cato Institute's 40th Annual Monetary Conference. By the way, if you can hear me, just make sure that you give me a thumbs up. I just want to make sure the audio and the video is working well. And we should be all set and good to go with this. And again, as soon as it starts, we'll listen in and we'll see how the markets are reacting. Right now, obviously, QQQs are down about 0.5%. We've got S&P down about 32 basis points. We had a very strong rally yesterday, right? So yesterday, the NASDAQ was up over 2%. We got the SPY pushing up over 1.8%. And the Dow Jones also pushing up 1.3%. So we'll see. It was kind of overdue. We were very oversold. We had 7 consistent days of red. So it made sense why the markets were in the mood to kind of push higher. We had both the 10-year yields and crude oil prices, both of them kind of falling on the same day, which definitely created a little bit of optimism in yesterday's trading. So a very strong day, but we'll see how today kind of ends up being. Right now, we still do have crude oil kind of bouncing back higher. It's up over 1%, and the 10-year yields are a little bit higher. So they are just slightly up over 6 basis points. So just trading back up to 3.25%. So we'll see, how the day trades. So yes, we can take a look at the bull bear poll as well. So I'll just do that now. So markets today, I'll do green, red, and then flat, and we should be all set and ready to go. And I'll do like an audio check as soon as this thing starts in about 3 minutes. So we'll kind of make sure that we can hear and see the event, and then just let me know in the comments if everything is working well. So I'll just make sure that we are good on that front. So, all right, I don't expect anything new from Jerome Powell. I don't even expect, it's a monetary policy after 40 years. It's kind of like that conference. So, we'll see what the agenda is. We'll see what he actually has to talk about, because, there's a lot of different events that Jerome Powell is part of, and not every event he talks about monetary policy or inflation or anything like that. But this one's specifically to monetary policy, so we'll see what he has to say. And I have no idea how long this is going to be, though. It's going to start in about 3 minutes, and this could be like super long. Okay, so September 8th, it's going to start at 9 a.m. till 3:40 p.m. Eastern, but obviously I don't think he's going to be talking for that entire time. But I think he does come on board at 9:10, so 10 minutes after this thing starts. This should Jerome Powell should come on board to talk about monetary policy. So I don't think it's going to be anything other than what we already know. So I'm pretty sure it's going to be more of the same stuff. From my understanding, I think he's going to reiterate how hawkish the Fed needs to be and how restoring price stability is their number one goal. And I think the markets also rallied yesterday that Lael Bernard said that we're also keeping a close eye on the other risk factors. And not just focused on inflation on one side, right? Because that's kind of like what the markets got concerned about, is that the Fed doesn't really care. They really don't care about anything else other than inflation. If that's the case, then they're going to end up hurting the economy, and they'll still hurt the economy even though inflation isn't a number one goal. But she kind of eased some of that pressures yesterday, saying that, okay, inflation is our number one goal, but we are also paying attention to the risks of over tightening. So I think that was a big thing for her to mention. So, all right, so I'm going to do an audio check now. Just want to make sure it's working well. Just let me know. All right, perfect. I'm not going to play that right now until Jerome Powell comes on board, because sometimes I've done that and the music gets copyrighted, and I've had issues with that. So I'm just going to wait until Jerome Powell comes on board. But if the audio was good, we're just going to do that. Okay, a bit loud, but good. Okay, I'll just try to reduce that a little bit once he come on board, once he starts talking. So, but yeah, so we're going to keep the markets over here. I've got the QQQs on the top right. We've got the S&P 500 at the bottom right. And then, of course, we've got the actual speech lined up over here perfectly. All right, so Alfred says too loud. Kevin says too loud. Okay, I'll reduce that volume a little bit. Next time I do that audio check, I'll reduce that a little bit. So the reason is because the settings, the audio settings from a microphone are a little bit lower. So I'll update that here. Just give me 1 second. I'll make it pretty consistent. All right, perfect. So Oz asks, I want to short. Would you wait for the S&P to hit that 50-day moving average around 4,010, or or would you basically short right away as we've hit the 50 moving average on the hourly? So Oz, a great question. We've already kind of sold off from our August 16th highs, right? So we're down about 16%, actually 12% from those highs. So just from a risk reward standpoint, I mean, shorting, well, depends what time frame you're looking at, right? If you're looking at the hourly, all right, I'll just answer this question after this speech, I promise. Let's just listen in.
Studies at the Cato Institute. Welcome to Cato's 40th Annual Monetary Conference. Pleasure to have you with us today. Our first conference, The Search for Stable Money, was held in January 1983. That search continues as we face the highest inflation in 40 years. A short time ago, the Fed was worried about hitting its 2% inflation target. In 2020, the central bank implemented a new monetary framework, flexible average inflation targeting. The idea was to make up for shortfalls by temporarily allowing inflation to exceed 2%, while averaging 2% in the longer run. Yet, no specific time frame was given. This flexibility increases uncertainty about the Fed's commitment to price stability. Until recently, the Fed's mantra in setting its policy rate was lower for longer, but forward guidance was often misguided. The Fed's macro models were unreliable, and forecasting errors eroded confidence in monetary policymaking. The Fed initially saw inflation as transitory and was slow to increase its policy rate. However, the consensus has changed, and the Fed has made it clear that rates will rise until inflation falls to a more normal level, even if the U.S. faces a recession. Of course, the underlying problem with our current monetary regime is that too much is expected from policymakers. The limits of monetary policy are often forgotten. Moreover, there is no clear rule for guiding policy. Karl Brunner, who spoke at Cato's first monetary conference, pointed to the importance of rules in the conduct of monetary policy, given the complexity of the real economy and the knowledge problem. According to Brunner, quote, we suffer neither under total ignorance nor do we enjoy full knowledge. A non-activist, that is rules-based regime, emerges under the circumstances as the safest strategy. It does not assure us that economic fluctuations will be avoided, but it will assure us that monetary policy does not impose additional uncertainties on the marketplace. With its large staff of economists and access to massive amounts of data, the Fed missed forecasting the 2008 financial crisis and missed warning signs of the current inflation. At a forum hosted by the ECB in June, Fed Chairman Jerome Powell stated, quote, "We now understand better how little we understand about inflation," close quote. I hope today's conference will help shed light on the causes of inflation and provide positive lessons for improving monetary policy. Before moving to the Earl J. Bowen Jr. and Duval Bowen Family Foundation for supporting today's event, I'd also like to thank Cato's excellent staff for helping with the conference, especially Nick Anthony and Kiana Graham, as well as David Tassi and Jonathan Fields. Finally, thanks to all our speakers and moderators for taking time from your busy schedules to join us. Now let's begin with Fed Chairman Jay Powell and Peter Gettler, President and CEO of the Cato Institute. Thank you.
Thanks, Jim. Good morning, everyone. As Jim said, I'm Peter Gettler. It's my honor and privilege to be president of the Cato Institute. Before proceeding, I want to offer my congratulations to you, Jim. Cato's been an important voice in the monetary realm for over 4 decades. And while there are lots of people who have contributed to this, no one has contributed more to this work than our colleague Jim Dorn. He's played as large a role as anyone. Jim inaugurated our monetary conference, and under his leadership, it's become an annual institution. Jim's presided over each of these conferences, including today's, which, as he pointed out, is our 40th. Following these past 40 years of service to Cato and our mission, during which he also created and edited our Cato Journal, Jim will be retiring later this month and will assume the title of Senior Fellow Emeritus at the Institute. Jim, I just wanted to offer our heartfelt thanks for your many contributions as one of the longest tenured employees in Cato's history. And I offer you best wishes for a fruitful and enjoyable retirement. I know you'll continue to make your voice heard in the policy debates and in the policy world, but I also hope you reserve plenty of time to enjoy your wonderful family. And now let's turn to our 40th Annual Monetary Conference. It's my honor and pleasure to welcome Fed Chair Jerome Powell to the conference. Along with Alan Greenspan and Ben Bernanke, he's now the third chair of the Federal Reserve Board of Governors to address the conference. Jerome Powell was first appointed as chair in 2018 and then reappointed this past spring. He's no stranger to the Fed. Prior to his time as chair, he served as a member of the Board of Governors starting just over 10 years ago.
Okay.
The one certainty that seems to come with the position of Fed chair is that one will invariably face a time of great challenge. Paul Volcker confronted our last and worst bout of inflation. Alan Greenspan saw the stock market crash a mere 2 months after his confirmation. And Ben Bernanke led the Federal Reserve amidst the financial crisis of 2007 and 2008. And Chairman Powell, as we all know, has served throughout the COVID-19 pandemic and its aftermath, a period in which we've seen inflation reach its highest level in 40 years. As we've sat in front of Zoom screens over the past 2.5 years, I'll just speak for myself. Many of us have watched as our hair has turned grayer, but few of us have as good an excuse for this as Chairman Powell. We're delighted to have him with us today to have a conversation about key policy issues, what he's learned, and the challenges now facing the Fed. Chairman Powell, it's good to see you today, sir. Welcome.
Thank you very much, Peter. And thank you to, go ahead.
I don't think it's a failure of imagination on my part, nor do I believe anyone will be surprised if the first topic we turn to is inflation. As Jim mentioned, it seems policymakers were given, including at the Fed, were initially given a bit of a head fake on inflation. We heard policymakers ascribing the increase in price inflation to the pandemic and related supply disruptions. And while this has undoubtedly contributed, there seems a much stronger consensus now that it's been in larger part policy driven. Can you discuss for us or give us some insight into how your thinking evolved on this topic over the last year and a half, and how those conclusions may have evolved as well?
So, Peter, thank you, and Jim, thank you, and congratulations to both of you and to Cato on 40 years of great monetary policy conferences. So I think a good entry point for that question, Peter, is to start by recalling that before the pandemic, unemployment was at a 50-year low, inflation was low and stable, and the economy was growing steadily, with no obvious imbalances threatening continued expansion. So, of course, in that sense, none of this high inflation that we see around the world now would have happened without the pandemic. The pandemic severely disrupted the economy, gave rise to risks of much more dire economic consequences than actually transpired, really. And that was thanks in part to the policy response. So to start with policy, there's no question that policy certainly supported strong demand. But in my view, you would not have seen anything like the inflation that we have seen without the pandemic effects. And those pandemic effects include both shifts in demand and also playing a role in, not solely causing, but playing a role in the supply side constraints that emerged. So as for the pandemic, it did lead directly to an extraordinary shift in demand away from in-person services and to goods. And that shift, of course, was a major contributor to inflation in goods prices, which was really the main inflation story at the very beginning when inflation broke out suddenly in March of 2021. It's worth remembering that inflation actually declined in the early stage of the pandemic and then suddenly rose up in March of 21. The pandemic also contributed to constrained supply in a number of important ways, including a large and persistent reduction in the size of the labor force, which contributed to extremely tight labor market conditions and upward pressure on wages. Also, the turmoil in global supply chains was probably caused to some extent by pandemic-related shutdowns as well as strong demand. and particularly goods demand. I think cars are a good example. So yes, people had money and rates were low and demand for cars was strong, but also the pandemic shifted demand upward for cars because some people wanted to avoid public transportation. That amped up new demand for new and used cars. And also the shortage of semiconductors for cars emerged from pandemic-related demand shifts as well. So, the bottom line for me is that there's really a role for both here, and the two are tangled up in a way that it's really not easy to disentangle.
Those of us who grew up in the 70s, I think that the danger and cost of inflation, can't be exaggerated. In September of 1979, his first testimony, a month after he was confirmed, Paul Volcker made clear he understood the damage that was being caused by inflation and the need to bring it down, even if it required great costs in other economic ways. One of the lessons of that episode was the greater the extent to which inflation slips the leash, the higher the cost and greater economic damage necessary to bring it under control. I worry whether we have the resolve to bring inflation under control today, to face the potential economic costs. I took some comfort from your recent remarks in Jackson Hole, which seemed an attempt to signal that kind of resolve. But I do remain concerned that, the intense political pressure that might be brought to bear to avoid collateral economic damage before the inflation fight is won. And I just wondered if there's any way you can help me sleep a little bit better on that score.
Sure. So I think it's worth going back and remembering, and I pointed this out in my remarks 2 weeks ago at Jackson Hole, 10 days ago, that what Paul Volcker did and the Fed did to finally get inflation under control followed several failed attempts to get inflation under control. And what had happened over the course of that long period of the Great Inflation is that the public had really come to think of higher inflation as the norm and to expect it to continue. And that's what made it so hard to get inflation down in that case. So it is very much our view and my view that we need to act now forthrightly, strongly, as we have been doing, and we need to keep at it until the job is done to avoid that. We think we can avoid the kind of very high social costs that Paul Volcker and the Fed had to bring into play in order to get inflation back down and set us up then for a long period of price stability. That speech, the point really there was to deliver a speech that was narrowly focused on inflation, more direct and a lot shorter than a typical Jackson Hole speech. And I thought that what was appropriate was a very, kind of concise and focused message. To your question, the message really was that the Fed has and accepts responsibility for price stability, by which we mean 2% inflation over time. That, again, to your question, the longer inflation remains well above target, the greater the risk that the public does begin to see higher inflation as the norm. And that has the capacity to really raise the costs of getting inflation down. So finally, history cautions strongly against prematurely loosening policy. I can assure you that my colleagues and I are strongly committed to this project, and we will keep at it until the job is done. I can also assure you that we never take into consideration external political considerations. We are accountable to the public through Congress. That's a very fundamental, important aspect of our work. But we do not. We focus solely on the goals that Congress has given us, and that's what we're going to do here.
I think that that's really important because it's clear that we could see, political pressure coming to avoid economic costs when there could be claims from political players that, inflation is back in its box, long before it is. Jim mentioned in his opening remarks that 2 years ago you moved to a new framework, flexible average inflation targeting, and I'm bringing this up now because, again, just reiterating the point about trying to sleep better at night. By many accounts, this move has created some more uncertainty in the market, as Jim mentioned. And coming at a time when inflation now has increased so markedly, it creates concern that despite your stated resolve, the commitment to price stability has become less strong. Should you consider modifications to this framework to assuage these concerns? And better manage short-term expectations?
So the framework, we began the work on the new framework in 2018, and we announced the results in August of 2020. And it really followed 25 years, basically, of global disinflationary forces. And the problem was that monetary policy rates were close to the effective lower bound much too much of the time, much too close, and even during good times. So that meant that central banks were having a hard time all over the world, finding ways to support the economy when it was needed. And that's why central banks, including the Fed, resorted to things like forward guidance and asset purchases. So that's why we did that. But the changes that we made were sort of a very mainstream part of a literature around makeup strategies. But really the point of our framework changes, the point of all of them was to, and we said this very clearly, was to have inflation expectations well anchored at 2%. That the average inflation targeting idea was meant to support having inflation expectations. That is the goal at 2%. And the reason is that we believe that the public's expectations of future inflation will play an important role in the actual path of inflation. So that is kind of the fundamental basis of our framework. And as I just discussed, it is very important that inflation expectations remain anchored. I think the evidence today is that if you look at longer term expectations by households, businesses, and forecasters, and also markets, you'll see that they are pretty well anchored around 2%. Of course, short term expectations are higher because of high current inflation, and also the clock is ticking. As I mentioned, the longer that inflation remains well above target, the greater the concern that the public will start to just naturally incorporate higher inflation into its economic decision making. And our job is to make sure that doesn't happen. And we're committed to doing that job.
It seems to me there's a chance that there's a real risk that the labor market, that the labor shortages persist. Does that create a risk that takes some of the ability to manage this process out of your hands? To the extent that there continue to be labor shortages, does that then feed into expectations that the public has about inflation, as you mentioned very prominently?
Well, I think you're right that if it does turn out that we are in a world of a persistent labor shortage over time, that'll be a challenging world for companies, and it will certainly create upward pressure on wages and that sort of thing. Today, the labor market demand is very, very strong still in the labor market. We're still printing new payroll job numbers at a high level. Wages are running at elevated levels. And so we think by our policy interventions, what we hope to achieve is a period of growth below trend, which will cause the labor market to get back into better balance. And then that will bring wages back down to levels that are more consistent with 2% inflation over time. That's what we're trying to achieve. The shock to labor supply that we got from the pandemic was large and unexpected, and unfortunately persistent. I will say that just in the very last labor market report that we got last Friday, we did see a welcome increase in labor force participation. Nonetheless, still a full percentage point below where it was before the crisis. And I think it's important as a society that we have measures in place to support a strong labor market and high labor force participation. And that goes beyond what we can accomplish with monetary policy.
You've made some contrast to how things are different today. What's different today from the high inflationary period of the late 70s and early 80s? I guess some other distinctions are, I remember as a student in Boston in the early 80s, in the days before the internet, I remember seeing people actually line up at the Fidelity office to see the monetary aggregates released on a weekly basis. And the way the money travels through the economy has changed dramatically since Milton Friedman first said that inflation is always and everywhere a monetary phenomenon. I'm just wondering, how do you respond when people look to the huge spike in government spending and say, I think you answered this in part in the first question, but when you look at the huge spike in spending and say the Fed's printed all this money, so of course we have inflation.
So I too, I graduated from college in 1975, which was close to peak monetarism, and there was quite a focus on monetary aggregates, and I recall it just as you do. So to go to this current situation, so as part of our response to the pandemic, we did resort to large asset purchases to address what were pretty severe disruptions in markets, and then also to support the economy, and our balance sheet expanded dramatically. But remember that our purchases of securities don't actually increase the quantity of government obligations held by the public. They really change the mix because we issue bank reserves to pay for those securities. So we're not changing, the quantity of obligations. That is not to say that money growth wasn't high. It was, of course, extraordinarily high in 2020, and then slowed down in 21, and now is quite sluggish. And I guess I would just say it this way: whatever caused, there are different theories on what caused the inflation that so suddenly jumped up out of the ground in March of 2021. Whatever that cause was, the relationship between the money supply and inflation, economic output, has been much more unstable than it was in Friedman's day for a very long time. And so literally changes in monetary aggregates have not had a consistent, reliable relationship. They haven't been a good predictor of the economy or of inflation. Now, of course, the economy is ever changing, and that too could change, to where it is important again. But for now, and for really many years now, monetary aggregates don't play an important role in our formulation of policy. And we don't think they're generally a good way to think about policy or about inflation. It's more about demand and supply and things like that. So that's where we would be on that.
That actually calls to mind, at Cato, we do have a strong aversion to a fully discretionary fiat money system. And so we do like to socialize and promote alternative frameworks that could put policy in a market direction that eliminates some of this discretion. Jim mentioned that a consistent theme over the years of this conference has been, potential monetary rules. And that kind of calls into question whether inflation and prices are really the best targets to use for monetary policy. Some folks have advocated for a rules-based system, such as targeting nominal GDP is something we've heard a lot about in recent years. Partly because, as you say, monetary policy is not suited to address, well suited to address supply shocks. Could you share with us some of your thoughts of that type of approach and whether it's something that you would consider?
So more broadly on rules, of course, Taylor rules have become part of the fabric of economic analysis and particularly monetary policy analysis in ways that must be far greater than John Taylor could have hoped when he wrote his original article in 1993. So, but no central bank and the Fed has never explicitly tied our monetary policy decisions to any formula, including Taylor rules. But Taylor rules, nonetheless, are ubiquitous in all of the work that we do. You have to have a variable, or a way and a model of explaining how monetary policy will react, and some kind of Taylor rule is now very much part of the way we think. In terms of nominal income targeting, and by the way, I know that Cato is one of the home courts for nominal income targeting, along with Mercatus and some others. And I know that this is a lot of well-known experts, many of them at your institution, do support nominal income targeting. And I'll just say that, we've looked at that, I've looked at that, and really come to the view that nominal income targeting is not the right way to go. And I'll try to explain why. By the way, I know that these arguments are well known to nominal income targeters and will be found to be unpersuasive. But nonetheless, I'll just give you my
and one thing I would interject is that we have debates internally as well, and I think for us the concept really is more, wanting to socialize a number of alternatives and try to move towards alternatives that do have more of a market basis and again remove discretion.
I think that's a very healthy process, and the whole debate over many years about rules and discretion is a fascinating and important one that is far from over. So it's really a mix of the two. I think but getting to nominal income targeting, we've got a dual mandate: maximum employment and price stability. And it comes down to, is nominal income targeting the best way to promote that? We don't think it is. I don't really think it is. And part of that just is that it would be, I think, very difficult to explain to the public the relationship of a nominal income target, nominal GDP target to those goals. It's a level of complexity that, even some economists and policymakers struggle with, let alone the general public. So it seems like it would be a reach to sort of put for us to have that be our fundamental framework. And a couple of examples that would be difficult. One in particular would be, what do you do with changes in trend growth? We have, highly uncertain estimates of levels of trend growth that we amend down through the years, and many years later, we may have a very different view. But it is broadly understood, I think, or thought that trend growth has declined considerably rather, over the course of since the global financial crisis. So how do you incorporate that into a nominal income target? Do you just raise the contribution of inflation, or do you annually re-estimate trend growth? And if you do that, you're incorporating both communications issues, but also, just big chances of policy error, because we just don't know these things with that kind of, we don't know any of the starred variables, so to speak, with that level of certainty. So I'll just say it's really interesting, and it works very well in models, but it seems difficult to implement from a practical standpoint, and it's not something that we have chosen to do, or that we are currently looking at.
You mentioned a dual mandate. I don't want to ignore the unemployment rate during this conversation. When I said earlier that, we obviously have an aversion to a, fully discretionary monetary system, many of us also regret the adoption of the dual mandate in lieu of a strict focus on monetary stability. The Fed's own website acknowledges that maximum employment is driven mainly by non-monetary factors. And if we accept that, does it really make sense for employment to be part of the Fed's mandate?
So, Peter, as you know, we're created by Congress in statute, and Congress assigns our goals, and it has assigned maximum employment and price stability. It's my view that the dual mandate has served the public well and is generally workable. In particular, at the moment, I don't see the two goals as in conflict at all, because without price stability, we will not be able to achieve the kind of strong labor market that we want for a sustained period that benefits all. So I don't see a case for moving to a single mandate, but that's really a question for Congress, and we will of course implement whatever mandate Congress gives us. To your point about maximum employment, it's true that, and we do say that and have for some time, that non-monetary factors are really what drives the level of maximum employment, which clearly changes through the business cycle and over time. But we can and do assess that, and we do it transparency, and Congress has said that should be a goal, a co-equal goal with price stability. So that's what we're implementing. And again, I don't think there's a strong case for changing that. I don't think it hampers us in our pursuit, and I think we can achieve both goals in the medium term.
You stole my follow-up, because you started out saying Congress sets the mandate, and so my follow-up was going to be, well, should the mandate, should they consider changing the mandate? And I think you've answered that. But I guess a natural follow-up might be then that, if the dual mandate weren't enough, there's been talk of adding more elements to the Fed's objectives, including like racial equity that seem far from the Fed's ability to address. In addition, the Fed's remit has expanded from the banking system to the broader financial system, and its regulatory responsibilities were widely expanded in the wake of the financial crisis. How does continuing expanding the Fed's mandates not undermine focus on that fundamental responsibility of monetary stability, beyond things such as the employment element of the mandate?
So I think our current mandate is appropriate, and I would not want to see it narrowed or broadened for that matter. We've got narrow and we've got well-defined goals that we're supposed to pursue. And what we've gotten with that is a precious grant of independence that lets us pursue those goals without direct political control. For monetary policy, that's maximum employment and price stability. And I think that dual mandate has served the public well. I really don't think it would not be a good idea to broaden it to goals that might be inconsistent with those two mandates, and that would be very difficult for us to achieve with our tools. More broadly than that, though, I think it's really important that we stick to our assigned tasks and resist the temptation to take on issues that are the province of elected representatives or of Congress. And if we do that, if we do stray from our core mandates, that will eventually undermine the case for our remaining independent. And I think, Fed independence is an institutional arrangement that has served the public well. And I think that's pretty well documented and accepted.
I mentioned a couple of times, our concern about a fully discretionary system, and one of the biggest of those concerns is that in the face of large economic dislocations, we've been running what really amount to unprecedented experiments. I would cite the quadrupling of the Fed's balance sheet in the wake of the 2008 financial crisis, and then doubling it again during the pandemic. To your credit, it was right before the pandemic that you were beginning to move towards reducing the balance sheet. Could you shed some light for us on where you hope to take the balance sheet over time, and what's the way that you really try to get there? Do you see the Fed ever moving back to a scarce reserve framework like it had before the 2008 crisis?
Sure. So in the last cycle, after we ended our asset purchases, we froze the size of the balance sheet in 2014 and then allowed it to shrink passively relative to the size of the economy for about 3 years. So as the economy grew, the balance sheet didn't grow. Then in 2017, we began to allow maturing assets to run off, and that process went on until 2019. By the end of that period, we had a balance sheet that was significantly smaller relative to the size of the economy and smaller than it was overall. So then we resumed asset purchases, as you know, 2020, and once again now we are embarked on shrinking the balance sheet, and the test will be back to levels that satisfy the public's demand for our liabilities. That's currency and reserves and things like that, but also with reserves maintained at levels that are consistent with our ample reserves regime. So the balance sheet is substantially larger now, obviously, and consequently the runoff process is designed to be substantially faster than in the last cycle, to the tune of on the order of $1 trillion of runoff per year. That process began in June, once it's up to full speed. The process began in June, and the pace of the balance sheet increases, actually rises this month. The plans are spelled out in detail on our website around the January and May meetings. And of course, one thing we always say is that we're prepared to adjust the details of the plan based on economic and market developments at any time. As far as returning to a scarce reserve regime, I guess I would say that I think that our current operating framework is a better one, and I don't see a case for returning to scarce reserves. Now, why is that? So the world has really changed as a result of the global financial crisis and the pandemic. The scarce reserves framework would be challenged to work in a world where there's very high and sometimes volatile demand for safe and liquid assets. Central banks may need to rely on large-scale asset purchases again from time to time in response to severe shocks. And remember that the large financial institutions hold very, very large quantities of safe assets now as a liquidity buffer, and that includes a lot of reserves. So the bottom line is that the quantity of reserves is just so much higher. It would seem to be impractical to try to manage scarcity, and demand will be volatile too. So it doesn't seem practical. And again, we think that the current system works well and provides a lot of liquidity to the system, which is kind of a net gain.
All right, I thought it might be time to shift gears a little bit away from inflation and monetary policy. I remember in the first year I joined Cato, I read an op-ed in the Wall Street Journal advocating for the Fed to implement a digital currency. And I was kind of horrified at the privacy implications of this prospect and said so in a letter to the editor at that time. Since then, the Fed has formally stepped into the digital currency ring, and digital currency has obviously been a very recurring theme in these conferences, but the Fed has stepped into this arena with a discussion paper on a central bank digital currency and several speeches from Fed governors. Our team has reviewed the more than 2,000 comments that the Fed's central bank digital currency discussion paper received, and we find that about 2/3 of them are concerned or outright opposed to the idea. Commenters raised concerns of financial privacy, financial oppression, and disintermediating the bank system, some of the same concerns that led me to write that letter to the editor 7 years ago. How can these serious concerns about privacy and freedom be reconciled with a digital currency?
Let me start by saying that we haven't made any decisions at all about whether to issue a CBDC, and we continue to evaluate the pros and cons and look at the technical questions and the policy questions, and we expect that evaluation process is going to take some time, appropriately so. Secondly, I'll say that we do not intend to proceed with issuance of a CBDC without clear support from both the executive branch and from Congress, ideally in the form of a specific authorizing law. So we did it was very gratifying, 2,000 and some comments. And, I won't tell you that I've read those, but I've read all of them, but I've read some of them and I've read the summaries. And, it's a lot of very thoughtful concerns, including the ones that you raised. And there are things that we're considering very seriously. So we in our own paper, we suggested that a CBDC in our jurisdiction should be privacy protected, intermediated, widely transferable, and identity verified. So on privacy protection, let's start with that. Very, very important. And we all see what's happening with the digital RMB. And the issues with privacy. We would not want a world in which the government sees in real time every money transfer that anyone makes with a CBDC. That would not be something that would be at all attractive in the American context. So privacy protection is going to be extremely important, and we're attentive to striking a balance, of course, between law enforcement and privacy protection. But that can be managed in the same way that it's currently managed in the banking system, or in some similar way. In terms of another issue, really is disintermediation, and that really is a question of, if say you had an interest-bearing CBDC, it could be attractive. It could compete with deposits, could draw deposits out of the banking system. That could limit credit availability. That's another issue to be managed. I think one of the things that Cato mentioned in your was also the run risk issue, and that is the question of, are you creating an asset that would be very attractive in a panic or severe stress situation, and fostering runs. So look, it's going to be, as I mentioned, we think our role is this. We want to carefully and thoroughly analyze the public policy and technological challenges, public policy trade-offs and technological challenges. That's what we're doing. The idea is that this will lead all of us to a better understanding of those trade-offs and prepare the way for, hopefully, a well-informed decision on whether and when to issue a dollar central bank digital currency. That's what we think our role is, and we think that the Fed is the right institution to do that. We can proceed without, we're a nonpartisan institution, non-political institution that we can do these things, and I hope present conclusions and analysis that will support an intelligent decision when it's time to make that.
Well, this is something we'll definitely be having a lot to say on in the future, as well, really from a perspective of privacy concerns. That's and being a watchdog on those issues is a very important role for Cato. I do want to ask about cryptocurrency, but first I should probably, in fairness, reveal that the gentleman who photobombed Janet Yellen 5 years ago by holding up a buy Bitcoin sign behind her during her Humphrey Hawkins testimony earlier this year became my son-in-law. So that's a little bit of a disclaimer I'm going to put out there. But without debating the merits or future of cryptocurrencies generally, or one or another crypto products, I'll say that in the monetary arena, Cato stands for nothing if not a desire to see more interest in monetary policy, to see more people concerned about our discretionary fiat system. And also, we want to see private market innovation and experimentation in developing alternatives, and crypto is just such a great example of this. There's a long history of government and regulation thwarting such innovation and experimentation, which we find really disappointing. So I wonder if you could respond to these kinds of concerns, namely that regulators might ultimately strangle crypto to the extent that it really does develop into a viable alternative system.
So I'll talk about it in two pieces. One is unbacked cryptocurrencies as such, and those have not and don't appear to offer, have not offered and don't appear to offer much in the way of public interest in using them as payments. Let's say it's not a great store of value. What it is a speculative asset. It's not backed by anything.
There could be an argument that that's still during the development phase, and that it's something that we could see emerge. But
yes,
be that as it may.
And I also have close in family members who offer that perspective vigorously. So, as you suggest. But stablecoins is a different thing, and the question is, are there forms of private money like stablecoins which can play a role in our financial system, which would, and the answer is, of course, that we don't want to stand in the way of appropriate innovation, particularly including, digital innovation. But we think that something like that, which is, purporting to be money, would need to be appropriately regulated. And I hear that wide agreement on that, by the way, from a lot of the stablecoin companies now are seeing that as part of getting to a place where they are a legitimate part of the financial system. So I think you need regulation. If people are going to think something is money, then it needs to actually have the qualities of money. And if it doesn't, then you don't want. I don't think you want to take money and make it into just another consumer product where sometimes it fails and sometimes it's good. You want it to be guaranteed to be good. If the public's going to look at it like it was a dollar, you want to have clarity, transparency. You want to have full reserves of very liquid, high quality assets, and things like that. That's all. So I think that we need legislation on this. Just it's typical of technological innovations. There isn't a regulatory framework that really gets after payment stable coins. And so I think that's what's needed. But I wouldn't think of us as being opposed to that kind of innovation. We're more the people who are saying, among others, that we need appropriate regulation.
Mm-hmm. Yeah, and the devil's ultimately in the details. I mean, while we have these debates, I mean, we would concede, we're living in a world where we will see innovation, and we basically promoted, a light touch, market focused approach, because there is a real risk of again, having an impact on the development of these innovations and really thwarting what could be very promising and useful innovation.
No, and I agree with that. We don't want to be in that place. We want to be in favor of innovation, but also of appropriate regulation.
Mm-hmm. And ultimately, some of the people who end up driving, the regulation might be, as you mentioned, legislation. The end product may not meet the objectives that you and I both say that we want. Another topic, as long as I can remember, successive chairmen have warned of our unsustainable fiscal path. Regrettably, no one in Congress or the White House seems to be listening. I'm, particularly during a period of high inflation, I've been, continually chagrined at, the number of big spending bills that continue to come down the pike and legislation that's passed. Long after I think the crisis of the pandemic has ended. The lessons of the financial crisis and COVID might be that keeping our fiscal house in order is essential as preparation to meet the challenges of unexpected but inevitable, economic dislocations. But the opposite lesson seems to have been learned, that we can keep spending, whatever we wish without worrying about a day of reckoning. And I just, I'm very concerned about the day of reckoning and what risks we're laying for the economic well-being of future generations. And I just wonder, your thoughts on those concerns and the potential timing of that day's arrival and its consequences, and whether you have any ideas about how we can build a real constituency for fiscal responsibility in America.
So I do share those concerns, and in fact, I was working on those issues before I joined the Fed. But at the Fed, my position needs to be that fiscal policy really is the responsibility of Congress and the administration. Wouldn't be appropriate for me to comment too much on specific policy proposals or laws. More to the point, with inflation running so far above 2%, this is probably an especially good time to focus on achieving our own mandate rather than doling out advice to others. But like my predecessors, I'll point out that our federal fiscal policy is not on a sustainable path, and it really hasn't been for some time. And we will need to get back to a sustainable path sooner or later. To your point, sooner is better than later. And I guess I'll just leave it at that.
All right, thanks. We're getting close to the end of our time, so I'm thinking about a closing question. I wonder, with everything that we've discussed thus far, what are some of the key lessons that you've learned since you became Fed chair, and what advice might you give to a lot of the young, monetary scholars out there that Cato and other places are working to develop?
So I guess I would say that both experience and also studying history are great teachers of what can be hard lessons. And I actually mentioned 3 lessons at Jackson Hole 10 days ago, and those were first that the Fed does have and accept responsibility for price stability. Even now, some are questioning that, but that to us is settled. Secondly, that inflation expectations are really important and need to be carefully monitored, because if they do move up, they can make the job of getting back to price stability so much harder. And third is that, the record is there is a record of failed attempts to get inflation under control, which only raises the ultimate cost to society of getting under control, hence the need to do this job now and keep at it. So those are 3 lessons. I would say more broadly, another really fundamental lesson is that the structure of the economy is ever changing and highly complex. And, we see that today around the world. Many nations are experiencing the first high inflation in 40 years, all around the world. Different countries have different composition and backstories, but it's really quite global. And the question really is this going to be a temporary thing that's really related to the pandemic in some way, or is there actually something more structural and persistent happening? For example, if we're moving to a world where we're going to see more frequent, larger, and more persistent supply shocks for whatever reason, that will have critical and difficult implications for the conduct of economic policy and monetary policy in particular. So this is not possible to know right now, but it's certainly a question that looms. I mean, to sum it up, I would just say economics is not physics. There isn't any specific temperature at which the economy boils over. It does boil over from time to time, and when that happens, it often takes many years of analysis, discussion, and debate to reach general agreement on why that has happened. So the point is that we are always making monetary policy under high uncertainty about the structure of the economy and the path ahead. That makes our work challenging. It also makes getting it right very important for the people that we serve, and we do think about that every day. So our understanding of the economy has to evolve. As the economy evolves, as time passes, we do learn more, and I think it's okay to follow the evidence and change one's mind. I think advice to scholars young and old is that people shouldn't be afraid to say that they've changed their view and explain why. I actually find that refreshing when people say, my view has evolved in the face of the evidence. I guess one more word to close for those young researchers you mentioned, and this is a commercial for public service and for the Fed. So the Fed is a very special place where people can combine policy research with policy making. This is a place that all of us have a very strong sense of mission in our work, which is very satisfying. And that mission is to serve the public. And it really matters. Our work really matters to the public. I would say there's no higher calling when we're satisfying mission. So I hope that young researchers and economists and others will consider public service as part of their career. For me, it's been only a part. But in particular, consider working at the Fed, where you'd be most welcome.
Thanks for that. I mean, I share those sentiments. As you mentioned your work at the Bipartisan Research Center, and I'm at Cato because I care about the future of our country and the future course of liberty and freedom in America, and for the kind of world future generations are going to grow up and whether they're going to have the same opportunities that we all have had to live in a free country and to pursue their American dream, and being part of that is a real privilege. I know, at Cato, we work very hard to raise consciousness of monetary policy and the potential for monetary reform. We wish that, we think this is a very important topic, and that more Americans should pay attention to it, even though it's complicated. We wish there were more policy organizations that would prioritize this policy area and raise their level of resources dedicated to this area. And as you know, Mr. Chairman, Cato is not shy about being critical, and we enjoy intellectually jousting with you and your team. But we also recognize that we share common goals and objectives for our country, and it's in the country's best interests, by which that jousting and those debates and areas of disagreement, it's within that context that they occur. And so I do thank you for your work. You're in a challenging position, and I thank you very much for being part of this conference today. It's been a real pleasure.
Thanks, Peter. The pleasure is mine too.
Thanks so much. And with that, I'm just going to let all the viewers know that we're going to be taking a break now until the top of the hour. So we're going to reconvene with the
All right, so that was a long stream, about an hour long. Lots of things mentioned. If you guys can hear me, just want to make sure that everything is working well. We do have QQQs almost kind of recovering back from those losses. It was down about 1% when Jerome Powell started talking, and we're seeing a lot of green candles right now. Of course, kind of driving that move is NVIDIA, pushing up, almost kind of regaining some of that losses. And then Tesla also up almost 1%, getting up to $286. Meta's up over 22 basis points, and Apple also pushing up over 34 basis points at the moment. So we did do a poll earlier. Let's just close that one out. 58% expecting. We got over 1,200 votes. That's insane. That's crazy. That's just make sure that you drop a like also. We only got 227 likes, so make sure that you drop a like here. But volatility here is slightly up, close to 1%. Crude oil prices also getting a little bit of a rebound after the sell-off from yesterday and the days before. It's up over 2% right now, just getting back over 83 levels at the moment. And we're seeing a very strong momentum coming in for the markets. Nothing really new. One of the things I think that he did kind of hinted on was the social cost thing, where he talked about where it is possible to achieve inflation back down, in other words, restore price stability without having those social costs for the economy, such as recession and unemployment, something that we saw back in the great inflation of 1970s and 1980s. So kind of hinting the possibility that, okay, there's still a chance for a soft landing. Of course, time will tell, but nothing really that was out of the ordinary, something that, we didn't already know about, right? Something that is already mentioned in the Jackson Hole meeting. Again, it's very, very similar. But if I'll go back and kind of re-listen and rewatch that video, if there's anything that kind of stands out, I'll definitely, share it with our members in our Discord. I'll share it in our summary video on YouTube as well. So that was that. And then, yes, markets here. The 10-year yield is also coming down a little bit. So they're slightly down about 64 basis points, so just under 3.25%. We got up to as much as 3.35. We're almost back up to those June levels from 3.5%. But right now, after this huge rally of 35%, we're seeing a little bit of a pullback right back down. And QQQs here, this is the chart. This is the actual pattern for the QQQs. Still a strong resistance at 293. That is a very, very important level of support. And then, of course, resistance stays put at $302 per share. And that's a resistance where we have gotten rejected at a couple times for the NASDAQ. So once over here, second time over here. So a couple of resistance levels for QQQs right now. We're kind of going back up to fill that gap. So again, I'd be very careful, at least, especially on the first 30 minutes when the market's kind of determining that direction, because we gap down, we fill that gap, and then the real trend or the direction would really begin, in my opinion, whether we have, what it takes to continue to push higher or we start to kind of roll over intraday. So Let's see. Let's just go over some of the questions now. So Purple says green or red. So we did have over 58% people expecting the market's going to be red, and over 31% expecting the markets to be green. So majority of the poll was a little bit on the red side. Powell still sounded hawkish, yet the market responded positively. Yep. I think it wasn't really the hawkish talk. It was just that there was nothing new for us to kind of talk about, right? I think all of us here, the 1,100 people watching right now, I think we can all agree that there was nothing, anything that he said that we didn't already know about, right? Things that he mentioned about the balance sheet, about the inflation, interest rates, kind of referring back and citing back to the 1970s and 80s of Paul Volcker, the 3 lessons that they've learned, kind of social causes, soft landing, everything was just like a known fact about what Powell has already mentioned. So nothing new for the markets. And the rule number 1 is the markets sell off on uncertainty. Uncertainty equals sell off. Uncertainty equals red. And if there's uncertainty, the markets will sell off. And on this speech today, I think there wasn't really anything new or uncertain. It was just the same stuff over again. Let's just quickly go over to the FedWatch tool. We'll take a look at how that's kind of changed, or if it's changed in terms of the interest rates probabilities for the September meeting, which happens in about 2 weeks or so. So again, September 21st is when we have the Fed meeting. There we go. So we now have over 85%, almost 85% probability for us to see a 75 basis point hike, and only a 16% probability for us to see 50 basis points, right? So it's pretty much a done deal now at this point, locked in with the 75 basis points for the most part, unless inflation numbers on the 13th, which is going to be next Tuesday, September 13th, if inflation numbers show a big improvement, right? I'm talking like prices going down on a month-over-month basis, right? We see deflation and sort of like a negative change month-over-month. Only then I could see maybe this number flip back over to 50 basis points. But right now it's pretty much 84% probability for a 75. And it's, yeah, wow, that's pretty interesting. So 84% probability for a 75, and then an 81% probability for us to see a 50 basis point hike, and then about 78% probability for us to see another 25 basis point hike. So the way the markets are pricing in right now is another 150 basis points worth of hikes: 75, 50, 25. Those are the next 3 probabilities, and right now it's kind of priced in that we're going to stay at these levels until June, July of 2023, which we know it's not going to happen. These probabilities will also change when the time comes. So, all right, so the gap is entirely filled for the QQQs, and now we'll see if the markets can indeed actually push higher on any volume. SPY also kind of went up there, so you can see how on the 5-minute chart we kind of gapped down, so gapped a little bit lower. So this right here was the entire gap right here that it needed to kind of fill in. So we gapped down, we pushed higher, and then we started to kind of fill that gap in, and now we're done. Now is going to be the real, in my opinion, the volume in the trading, because the gap fill is done. And that's going to be the SPY, and this right here is going to be the QQQs, almost an identical pattern. On the 5-minute, we kind of gapped down and then started to push higher, filling that gap, and now we'll see whether the markets can turn green. All says, will the markets hold 3,900 by next CPI? Maybe CPI hot and they stomp 100, or I can dream. Really, not really. So yeah, I mean, if CPI comes in way hot than expectations, I mean, if we start to kind of accelerate once again on a month-over-month basis, then that obviously is not going to be great news. If CPI print doesn't come in great, then we're not going to be looking at 75 or 50. Then the possibility for 100 might also be on the table. But we already know from our inflation tracker, we know from some of the commodity prices that are rolling over, we know from our inflation tracker, we understand that metals, materials, energy, I mean, they've all been rolling over. The only thing that's actually been pushing higher in the month of August, I would say, is actually natural gas prices. So in the month of August, we had crude oil pretty much drop 9.5%. And then if you come over to natural gas, in the month of August, it was actually up 10%. So natural gas is kind of like a wild card. It may, result in it might offset some of those price declines from crude oil. But then what's going to be really important also is going to be 2 things: food and shelter. Shelter pretty much makes up over 33% of CPI. So, rental, and we learned about that from the Beige Book today, as people are moving away from buying homes to actually renting them. And rentals and rates for rentals are actually going higher. So I wouldn't be surprised if that shelter part of that CPI starts to also push higher. And one other thing that we talked about in that beige book full summary report was the food prices. Almost all 12 districts saw a month-over-month increase in food prices, and energy was actually declined in 5 of the 12 districts. So energy is kind of playing its part. It is coming down, but it's food prices and shelter that's kind of concerning a little bit. That's pushing higher. So we're gonna have to pay attention to those 2 line items to really understand how and how low inflation gets down to, and what's that month-over-month change. So, but oil prices again showing a lot of weakness, pushing higher today though after the big sell-off. So. Yes, 13 is a CPI. That is going to be very important. And let's see. So Tesla's growth trajectory will continue and surpass NVIDIA. So, I mean, in terms of obviously growth, Tesla is phenomenal, doing really, really well. And NVIDIA is kind of guiding for decline in the upcoming quarter because of gaming revenues and, all the offsets on a year-over-year comps basis. So NVIDIA right now at 137, right now pretty much flat. I've got a CSP on NVIDIA, I have a CSP in Tesla, I have a CSP on AMD, and then I'm planning on selling maybe another cash good put on Google if it continues to sell off today. And then of course, if you do see some more weakness, then I'm looking at $190 strike prices for Google as well. So Cato gasoline at $2.96 per gallon in San Antonio. That's great. That's really what we want to see is lower and lower gas prices, lower and lower crude oil prices. Commodity prices going to roll over. That's going to eventually benefit the Fed and of course in their fight for inflation. Now, one of the things that I really, he did talk about a little bit about the path of the fiscal policy, and he also mentioned that that is something that Jerome Powell is concerned about, and it's not a sustainable path because every single year the United States is actually spending more money than it's bringing in through tax revenues. So he mentions obviously in a way that it's not a sustainable path, but I think the only way we get an actual opinion out of Jerome Powell on fiscal policy and the path of the U.S. sort of in terms of debt and deficits is when he's out of office, when he's no longer the Fed chair, then he can actually share his opinion. I think he's always too concerned about the Congress, and he always cites the Congress has given us this rule, given us this dual mandate, they've given us this objective, and we're just going to focus on that. He never comments on fiscal policy, he never comments on what the role the U.S. Treasury can play in helping monetary policy achieve price stability and higher levels of employment, low unemployment, stuff like that. Because, even on their website, as Peter mentioned, they've talked about how employment is affected and can be affected by non-monetary impacts, right? So literally stuff that's out of their control can affect employment. And yet it's just 2 independent authorities that don't work together at all, which kind of surprises me, kind of really, starts to wonder like why that would be the case, right? Monetary policy just focus on the demand side of things, and fiscal policy just focus on literally just spending and of course generating that deficit and increasing that debt. So I think it's a little bit of a longer discussion because this is something that eventually sooner or later will become the topic to focus on, which is the long-term sustainability of the U.S. Debt levels and the deficit. We also talked about Ray Dalio's paper and the topic on stagflation and what he thinks about the state of those unmanageable levels of debt. So it's going to be more so long-term. Again, it's not something that we need to be worried about like in the short term, but this is something to think about, and we'll have ongoing discussions about that in the future, in our future live streams and our future videos as well. So, all right, so if you get into a CSP and the stock goes up, can we close the CSP and lock in profits before the expiry date of the CSP? Yes, you absolutely can do that if the stock price goes up. So for example, NVIDIA, if it keeps shooting up to 140, 145, 150, then my cash secured put will be in profit and I will close that put. And usually what I do is I close the put when I'm 70% or above in profit. So if I'm plus 70% or more, then I close the put. But it also depends on how much time is left till expiration, because you're better off just closing a put at 70% profit if there's months left in expiration, because you're just better off locking in that profit and you can go ahead and write another one. But if it's like a day left or 2 days left, then I might as well just hold on to the rest 30% that can higher probability for us to get that back. So, all right. So Oscar says that Burry and Ray video was great. Thanks, Oscar. I really appreciate it. Glad you enjoyed that video. And I think more specifically, not really too concerned about what Burry's tweeting because he's been tweeting like crazy lately anyway. But I'm more concerned about what Ray Dalio has to say because I do see him as a very well respected, well thought out, knowledgeable macroeconomist and investor. And of course, you don't get to just running the biggest hedge fund in the world by knowing nothing, right? So he definitely knows a lot and shares his perspective and pretty much is giving away his research and knowledge and all that stuff. So I really appreciate that. And his thoughts really do spark that curiosity in myself and kind of learning more about these things and kind of understanding macroeconomics a little bit better and where we could potentially be headed from a fiscal monetary policy standpoint. Just considering that these long-term debt cycles are 75 years long, right? So when we cite long-term bull markets, when we cite, in the long term, everything's going to be fine. Long-term markets go up. Long-term, everything goes up, right? When we talk about those things, you have to think about what's that time horizon we're really looking at, right? Looking at 75 to 100 years, and that's exactly how long these long-term debt cycles last for. Until, of course, we get into that discussion of the Great Reset. So those are things that I will, look into. We'll do some more discussions and some more analysis on them. But right now, we got the NASDAQ here. So down about 0.5%. So we did fill that gap. Right now we're starting to see a little bit of a pullback again. Like I said, usually you'll see a gap up or a gap down. The markets will come down or go up, fill that gap, and then the real direction, the real trend really begins after that. And then we got the S&P 500 here on the 5-minute, also starting to roll over a little bit, but down about 44 basis points. And the Dow Jones here is down about 142 points as well. The 10-year yields kind of muted. Not really pushing all that much, but they have been going up quite a bit ahead of the balance sheet reduction plan from the Fed. So again, they're gonna start to accelerate those caps, which Jerome Powell also mentioned. And one of the things that I think is really important for us to remember is that mortgage-backed securities, they're gonna have to actively start selling their mortgage-backed securities because they don't mature for another, I want to say like 5 years. Last time I checked, it was 5 years. So they don't mature up until 5 years from now, so they're going to have to actively sell and take the loss on those MBS products. Which, what will that do to the mortgage rates? Pop quiz. We got over 868 people watching. I'm sure plenty of people will know the answer to this. But once the Fed starts selling their mortgage-backed securities and start reducing their balance sheet, what would that do theoretically to the mortgage rates? Joseph says, Econ 101 professor said, in the long run, we are all dead, so get to work and learn economics. I like that. So yes, go higher, right? So they will increase. And we know that residential real estate activity is already starting to kind of slow down. So, real estate and housing is also something to pay attention to. We're kind of read in the beige book as well. Most districts mention that residential activity, loan activity is kind of declining and it's starting to come down. So that's something to definitely pay attention to. All right, so let's take a look at the entire market in terms of different sectors and how we're doing on the year. So I'll just open up our select sector index chart here. This is, again, a complete overview of how sectors are doing, what's performing well versus what's performing worse. So this is on a year-to-date basis. So obviously we got the 10-year yields up 100%. The 10-year yields are now, since the beginning of this year, up exactly 100% right now. They've doubled since the start of this year. Volatility is still up 51%, and energy, XLE, is up over 37%. However, crude oil, after this decline, is now actually only up 9% from the start of this year. So if you go back to where January 1st was, right over here, somewhere over here, oil prices are now only up about 9% on a year-to-date basis. Very, very significant pull down on oil. So we got utilities up over 8%, mining is up over 8.6%, gold is up, well actually gold is down 5%. Staples are also down 6%. Then pretty much everything else, right? Healthcare, industrials, financials, biotech, SPY, silver, real estate, technology, discretionary, bonds, and QQQ's NASDAQ, everything is down pretty much anywhere between 5 to as much as 30% on the year. So very, very interesting. Obviously 2022 alternative. So 10-year yields are up, volatility is up, and energy is up because of oil. But everything else remains down on the year. And when we're talking about spreads here, 10 versus the 3 month is down 7%, so trading as low as 21 basis points. This one has not, well, actually, it did turn negative, but not in 2022. So it has fallen off the cliff quite a bit. So if I just make this chart larger, so you'll notice that this right here was the last time this spread between the 10-year and the 3 month was negative, right? This is back in 2019. This was right before COVID and before the recession that we had during COVID. Then we actually went up to as much as 2.3%, so that spread pretty much widened. And look at that fall from May to where we are right now, 90% drop in this spread, and we're getting closer and closer to 0%. So if this spread turns negative, another yield curve that would invert and which pretty much join the ranks of this one, which is the 10 versus the 6 month negative. And then of course we got the main spread, which pretty much anyone in the finance industry looks at, which is the 10-year versus 2-year, down 40% today and also negative. So that yield curve is also inverted, down negative 20 basis points. So that's where we are with the overall markets. Lots of consolidation. We did see a very strong rally after being a little bit oversold. I think we saw like 7 days of consistent selling for the market. So I think yesterday's push higher was pretty much warranted, considering the comments from Lil Bernard, oil prices coming down and yields also selling off. So yesterday obviously was a very strong day, but today we're kind of starting to see a little bit of sideways action where we're just not really moving much on the day. So intraday we're not really making any moves. So Belthus, I'm new here. Greetings to everyone. Do you trade Bitcoin? So thank you so much for joining. I really appreciate it. And we don't necessarily trade Bitcoin. We definitely do take a look at cryptos and we analyze them. But I personally don't trade Bitcoin or Ethereum for that matter. So, but yeah, thanks for joining. And our focus on the channel is pretty much fundamental analysis, technical analysis, and macroeconomics. We primarily focus on a lot of individual stocks and companies, and then updates on cryptos and commodities and volatility and yields and all that stuff as well. So Zim integrated shipping. So let's take a look. So one of the things that, wow, it's down 3%. One of the things that, I don't know if anybody caught that in the beige book. Let me see how many views we have, by the way. So on that full beige book, full summary, we have about 470 views. So obviously not a whole lot. What was one thing that was very interesting from the beige book that one of the districts mentioned? I don't know if anybody's gonna get that. I think it's like a too complicated of a pop quiz question. But it's related to Zim integrated shipping. That's your hint, if anybody remembers. Okay, I haven't got a chance to watch it yet. All right, that's fine. What they really talked about was freight rates, right? Freight rates are falling is what they mentioned. It was, I think, I forgot what the Federal Reserve District was, but they did mention that freight rates are coming down. And that is a big headwind for companies like Zim integrated shipping that rely pretty much on freight and shipping rates. I've pointed out this risk several times for Zim integrated shipping, that don't fall for the yield. It's a big dividend yield trap of just over 70 to 80% because they pay out of earnings, right? They pay the dividends out of earnings, and if earnings fall, which they're expected to if shipping rates come down, then well, guess what? Dividend yield is not going to be that attractive anymore, and the price earnings multiple that you see right now is not going to be that attractive anymore either. So definitely, pay very close attention to those things. If a deal in the markets is really, really good, it's like too good, then you definitely want to do more research on that. And I know that Zim integrated shipping got its reputation because of the dividend yield. TradingView shows 86%. It's like you can almost double your money with the dividends, but it's not that easy, right? There's no free lunches in the stock market. Market sees that, it recognizes that, and it's kind of discounting for that dividend yield. So from all-time highs, it's down over 56% at the moment. All right, let's take a look at advanced micro devices. So AMD, wow, up 2%. So very, very nice move back up to $81. This is one stock that, got down to like insane $70 at $79 per share level. So gladly we sold a put, so I have one. So right now just getting back up to $85 is going to be that next target. So this is the next resistance that we're paying attention to, all the way up to $93. and all the way up to 103. So we do have some levels of resistance to get up to. But AMD, one of the very few chip stocks that has held its guidance for 2022, that is still pointing to a 60% growth in revenues, and margins and cash flows are getting even better. They've got very little exposure to the China ban that we got earlier a couple of weeks ago that NVIDIA was affected by. So AMD also got a letter from the US government, but they're not affected as much as NVIDIA is when it comes to their fundamentals and their revenues. So again, AMD, in my opinion, on a growth adjusted, risk adjusted basis, one of the best stocks for the chip industry, semiconductors. So, all right, so AMD, let's take a look here. So indices are just, they're just kind of battling here back and forth. The QQQs hovering around 297, 298, and the SPY is also just hovering around 396, 397. So we're seeing a little bit of sideways momentum here for the markets at the moment. Next week is going to be really, really important. How excited are you about next week? We got inflation data. Everyone's going to be paying attention to that. It is by far the most important report that anyone's going to be looking at. Anyone's going to be paying attention to. So maybe we can do a poll for next week's inflation. Cool says I'm scared. Man, it's going to be exciting though. It's going to be, what those numbers are going to be month over month and year over year. Big reaction expected from the markets, of course. So I think if inflation comes down and the market starts expecting a pivot again, I could see that happening, and that may not be as bad as expecting a pivot even before inflation numbers come out, because if the Fed is going to pivot, it is because of inflation, right? So the market's reaction on a inflation read seems very appropriate, but the market's reaction on a weakening economy doesn't seem very appropriate, because regardless of whether the economy is in a recession or not, the Fed is still going forward with those rate hikes. So just because the economy is weakening is not a good enough reason for the Fed to start pivoting. So that reasoning, I think, is falsified. But if inflation starts coming down, I think that's a good reason to be pushing higher. So Brandon says used cars and gas prices have been falling off this month. That's great. That's exactly what we want to see. Prices come down. NVIDIA here pushing up 43 basis points right now, and so is Tesla, getting up to $285 here. So getting up over 67 basis points, 70 basis points at the moment. We got Meta just trading sideways, and Apple's been struggling. By the way, we haven't talked about Apple and its product launches. I got too caught up on Jerome Powell and the economy. So I watched a couple of reviews on YouTube, kind of breaking down iPhone 14, 14 Plus, Pro, and Max, the AirPods, and the watches. I think the big theme for this year's September event from Apple was safety. It was safety. I think pretty much every single, except for the AirPods, even then, I think you can just, literally say like, hey Siri, but everything was just kind of focused around safety, right? Even they started, like Tim Cook literally started sharing 7 stories, 8 stories of how the Apple Watch, saved lives for many people. So they really want to kind of hone in on the idea that, Apple products pretty much you want to keep with you like at all times, stuff like that. But there weren't any design upgrades or hardware upgrades, any noticeable stuff that kind of came on that, it was like a completely different phone. But there were many little tweaks on software, of course, new camera upgrade, and then of course the big dynamic island, which I think was the big seller. The one thing I'm not too sure about is the eSIM, right, which is the electronic SIM now, no actual physical SIM cards, where it makes it a little bit harder for people or consumers to kind of leave the Apple ecosystem now. So once you're kind of with the eSIM, you're pretty much kind of that wall of garden kind of keeps building around Apple ecosystem, right? So I think that was going to be a little bit more controversial, the eSIM. I know that some people are going to like it, some people are going to hate it. I personally am a little bit indifferent about it. So my plan is to actually get an iPhone 14 Pro this year, because I'm actually upgrading after 4 years. I've been using this for almost 4 years, so I'll be upgrading after a long time. So But that eSIM is something that kind of was like, I don't know. I don't know if I want to do that. But yeah, overall, Apple just doing what Apple does best. Just little refinements, little changes, little updates, and stuff like that. I think they do have some plans of getting into the metaverse and kind of competing with the Oculus and the company Meta, but they don't have anything refined yet. So I don't think they want to give anything away. So they didn't release anything on that front. But overall, I think the pricing was the same. They didn't change the pricing. They didn't increase the price for every iPhone. So no Apple Car. Yeah, I don't think they're gonna release that anytime soon. I think they're still working on that. No, Caddy, the eSIM will be in all phones soon, not only Apple. Okay, that's good to know. I think yes. So eSIM, but again, it depends very much on the infrastructure too, right? I mean, some of the emerging markets, some of the developing countries obviously don't have the infrastructure to support eSIM connectivity, but I think that is where we're headed. That is where we are going, like as just consumers of phones. So yeah, but overall, I think it was a good presentation. I mean, Apple is just right on with that marketing and all the music and all the effects and everything else. So it was just a good event, and right now it's just more or less flat, not really moving all that much. So, all right, so we're starting to see a little bit of momentum higher once again from the markets. We got NASDAQ now up over 16 basis points. The Dow is flat, and the S&P now turning positive, also very much up over 12 basis points at the moment as well. And volatility really coming down once again inside this 24-25 levels. So what do I think about Tencent? So Tencent, Alibaba, I think most Chinese stocks can be regarded as companies that are trading at very, very undervalued levels. I mean, Tencent at $38, down I think over 60% from its all-time highs. Fundamentally speaking, I think it's one of those companies down exactly 60% from all-time highs. Really, really undervalued in my opinion. But again, there's that risk in China, right? So there's political risk, geopolitical risk, and of course the risk related to all the scrutiny and all the regulations and all that stuff. So they're not able to fully trade at their potential value because of all those headwinds. So if you're kind of accounting for that risk and you understand all that, then Tencent can definitely be one of the stocks to look into. But despite all of that, I mean, there hasn't really been any outperformance in the last 2 years from Tencent, let alone any type of performance. I mean, it's just gone down since February of last year. Are you going to do Tesla Q3 earnings video? Yeah, absolutely. As soon as they come out. I think it's going to be a while. I mean, we just got done with second quarter earnings. Tesla doesn't report earnings until like October. And at that time, I'll actually be there in the US, so I'll do it from there, October 19th. So yeah, it's about a month away, a little bit over a month away. So we'll definitely do it. Steve says, Caddy, I wouldn't touch Chinese stocks even with your money. Yeah, I mean they're risky, right? So everyone's gotta analyze that risk appropriately and see whether it makes sense for them or not. We just learned that Ray Dalio pretty much dumped all of his Chinese stocks. I mean, Alibaba, I think JD.com, some of those names that he pretty much got rid of. I think he still has that emerging market ETF that is pretty much invested heavily in Chinese stocks, but his individual positions he pretty much got rid of in the second quarter. So Noman, is a semiconductor ETF SMH safe to hold for the next 5 years? Thank you. So, well, the short answer is going to be most likely. The long answer is that there are headwinds when it comes to chip stocks in the short term, and I would still make a case that some of the stocks within the SMH, more specifically Nvidia, are still trading at a level that's a little bit higher than what their valuation might suggest or what their fair value might suggest. So in the short term, like there might still be potential pullback or sell-offs, and possibility that it can come down even further and come lower. But over the long term, since you mentioned 5 years, then in my opinion, yeah, I think AMD, Nvidia, some of these names that are already part of the semiconductor ETF are going to do really well. I think, chips is one thing that pretty much all technological advancement requires certain chips and semiconductors. Yeah, I mean, this sector, this industry as a whole is on a consistent path to profitability, to growth, and it's going to be needed for years to come, for decades to come, pretty much in everything. Metaverse, AI, machine learning, robotics, you name it. Chips are going to be needed for everything. So, but it just depends on what valuation you want to buy it at, right? What level, what price point is appropriate for SMH and the underlying stocks that it has, such as Nvidia, AMD, some of those names. Yes, Tesla scheduled to report earnings for October 19th. Swapnil, welcome to the USA. Which states are you visiting? So I'll be in the East Coast, New York, Boston, and then I've got a wedding to attend in Denver, Colorado, and that's going to be about it. So just those 3 places. So are covered call, ETFs, and split share funds good enough for passive income, or we should also have growth stocks in portfolio? So really it depends. I mean, if you're asking about income, right? Income investing only, you don't care about capital appreciation, then things like QYLD are ones that you can definitely look into. But again, this is only income ETFs, right? They don't give you any capital appreciation. I mean, in fact, in the last, I want to say like 10 years or so, even though it has gone up, it has pretty much not really seen that much capital appreciation as compared to something like a SPY or a QQQ, right? If you come from 2016, it's gone up over 60%, right? In the last 6 years or so, 60%. So, but then of course they charge some fees, and the dividend yield is of course 12.5%. They pay monthly. But this is mostly for people that are only looking for that income and that don't know how to sell options themselves, right? So what this ETF does is pretty much sells covered calls on shares that they already own. So it is a possibility. But if you're looking for growth, then QYLD is not going to be the one or the right fit, like the covered call ETFs that you talked about. Mohammed, thank you so much. I really appreciate it. Thank you for the 70,000 subscribers, everybody. I really appreciate it. We were only like, I think, 12 or 15 people away, so it looks like we did hit that number. We'll do a pretty big live stream once we get up to 100,000, which I think is a long time until we get up to that level. But again, thank you so much. No, I'm not from. I actually won't be coming to California, unfortunately, Neeraj. But if I do, I'll definitely let you know. Road to Financial Freedom. Have you lived your entire life in India? Well, I actually spent 5 years in the U.S. Before moving back. But yes, for the most part, I've lived most of my life in India. So the markets here, flat, no movement at all. We did see a little bit of a gap down and then just pushing higher. So you got the S&P that can be about as flat as it can be, only down about 1 basis point. The Dow is flat. The S&P is flat. We've got a lot of individual stocks. Tesla slightly higher, Nvidia slightly higher, Apple flat, Meta is flat. So everything is just more or less sideways except for AMD, which is up 2.6% very nicely. And Netflix is down about 2%. So again, thank you so much for joining, everybody. I really appreciate it. And once again, hope you enjoyed the stream and Jerome Powell's commentary and speech, and a little bit of color on macroeconomics and inflation and interest rates. Don't forget, next week is going to be very, very important. Like, I cannot put enough emphasis on how important inflation week it is going to be for the markets. So thank you so much for joining. I really appreciate it. Make sure that you drop a like so we can at least get up to over 1,000 likes, maybe. Possibly not possible right now, but make sure that you drop a like so we can get up to a certain number, 500 maybe. And also subscribe if you haven't already. Make sure that you subscribe. If you're new to the channel, we talk a lot about fundamental and technical analysis. And also want to point out that we have the links down in the description below if you want to join and, of course, be a part of our money investing community. Discord and Patreon links going to be down. So we talk a lot about fundamental technical analysis, buy and sell alerts, options alerts, all that stuff. So thanks again. Really appreciate it. And as always, happy investing. Hope you all have a great green day. And I'll see you all first thing tomorrow morning for another live stream. Take care.